What property expenses can you claim to reduce your tax bill? In this video, we'll look at the different types of expenses, what costs they apply to, and when you can claim them. I'm James Poyser. I'm the CEO here at Provestor, the property accountants, and we're here to help you with all things property tax. First of all, what exactly is an expense? Expenses can be offset against profit, reducing the amount of tax you'll pay, either each year or when you come to sell a property. This is why it's really important to record and claim all expenses from running your property business. The PROVESTER accounting app, made specifically for property investors, makes this really easy. Many landlords don't realise that different types of expenses are treated differently. The key concept of this video is revenue versus capital expenses, which are the two main types of expense that you can claim. A capital expense is a cost incurred when buying or upgrading a property. You can only claim capital expenses once, and that's when selling a property. Capital expenses can be deducted from the gain or added to a loss of the property sale to reduce the amount of capital gains tax you'll have to pay. Typical capital costs include things like solicitors' costs and survey costs from when the property was initially purchased, stamp duty, land tax, again from when you bought the property enhancement costs, if you've added value to the property by building an extension, adding an ensuite or reconfiguring the layout, you can claim these as capital expenses. You can also claim estate agent fees from selling the property. The other type of expense is called revenue, and these are the costs incurred as part of the day-to-day running and maintenance of the property. They can be deducted annually from the gross profits at the end of the year to arrive at the net profits, which you pay tax on. You can see why revenue expenses are really important, as they can reduce your tax bill at the end of each year. Here are some typical revenue expenses claims. You can claim for property repairs, such as kitchen and bathroom fittings, windows, doors, and boilers. These must be like-for-like replacements, as any substantial upgrade in the kitchen or bathroom would be seen as a capital expense. You can also claim property maintenance costs, such as a cleaner and a gardener. Next is property business management costs. These include things like business insurance, accountancy fees, letting agent fees, and memberships of landlord or property associations. You can also claim furniture purchases as a revenue cost if you're replacing furniture that was already in the property when you purchased it. You can claim for business travel and subsistence costs when visiting properties. You can claim legal fees and the costs associated with arranging your buy-to-let mortgage or remortgaging. You can also claim for extending leases of up to 50 years, preparing contracts, and preparing deeds of trust. You can claim computer and mobile phone costs, but not the full amount unless used wholly for the business. The good news is, if you have a mobile phone or laptop that's not used 100% of the time for running the property business, you can claim a proportion of the cost. And finally, you can also claim utility and council tax costs if the property is empty. So we've covered capital and revenue expenses and what you can claim. Now let's take a look at the costs you can't claim, otherwise known as non-deductible expenses. Before we continue, I just want to call out some free resources that you might find useful. Head to the description below and you'll find links to our expert guides, calculators, and fact sheets, all of which are freely available on the Provestor website. Check them out and let us know in the comments if you found them useful. You can't claim property purchase costs for aborted deals. For example, legal costs, mortgage arrangement, and travel costs for properties you've not purchased. You also can't claim for new furniture purchases if there was no furniture in the property at purchase. Mortgage interest relief differs between limited companies and personal ownership. If you own a residential property as a limited company, your mortgage interest is viewed as a business expense. This means that the full mortgage interest can be deducted from the total amount of taxable profit, reducing the corporation tax you'll pay. However, landlords who own residential property personally are subject to a piece of legislation called Section 24. Section 24 restricts the tax relief available on mortgage interest to the basic rate of tax. This means higher and additional rate taxpayers will pay significantly more tax. Allowable expenses and navigating Section 24 can be a confusing and complex area for many landlords. If you're unsure about whether a cost can be claimed, ask your accountant or book a consultation with one of our property tax experts. Thank you for watching this video. I hope this has been a useful overview of property expenses. If you found this useful, please like this video, subscribe to our channel, and if you have any questions, drop a comment below. I hope you enjoyed this video, and I'll see you in the next one.